Welcome back to our YouTube channel, The Book Digest. In today's episode, we're diving into a powerful and practical summary of How to Make Money in Stocks by William J. O'Neill. It's a legendary system, and we're going to break it all down. For decades, investors have basically been caught between two big conflicting ideas. On one hand, you've got the value investors, right? The bargain hunters, always looking for those cheap, undiscovered stocks. And on the other hand, you have the academics telling us, hey, you can't beat the market, so don't even try. But what if they're both kind of wrong? What if the real secret to finding the market's biggest home runs wasn't buried in some complex theory, but was actually hiding in plain sight, in the data? Well, that's exactly what we're going to explore. So here's what we're going to cover in this breakdown of William O'Neill's legendary CAN-SLIM system. We'll kick things off with where this whole idea came from. Then we'll get into the nitty-gritty of the CAN checklist, followed by the SLIM checklist. After that, we'll talk about his super strict but super important selling rules. And finally, we'll wrap up with the biggest challenge of all. All right, let's start at the beginning. A detective in the market. See, to really get the CAN-SLIM system, you have to know its origin story. And trust me, this thing wasn't dreamt up in some university classroom. Nope, it all started with a massive investigation. So instead of just coming up with a theory, William O'Neill basically became a market detective. I mean, this guy went back and crunched the numbers on over 100 years of stock market history. He wasn't interested in what should have worked in theory. He wanted to know what actually worked in the real world. And what he found was incredible. 7 common traits that nearly every single superstar stock had right before they took off. And that discovery leads us right into the CAN checklist. This is all about finding that fundamental power. His biggest finding was actually a huge shock to a lot of people. The greatest winning stocks, they weren't these cheap, undiscovered little companies. They were absolute powerhouses that were already flexing incredible strength. So let's break down the first half of his checklist. Okay, first up is C for current quarterly earnings per share. Now, this is the first and honestly maybe the most important filter. O'Neill was pretty blunt about it. If a company can't pass this test, don't even bother looking at anything else. His data couldn't have been clearer. The biggest winners, the real titans, all had a massive, recent explosion in their earnings. He set the minimum bar pretty high, at least a 25% jump in current quarterly earnings compared to the same quarter last year. But the real game changers? Man, they were often showing growth of 50%, 100%, sometimes even more. So why does this matter so much? Well, think of a huge earnings jump like a flare being shot up into the sky. It's a bright, flashing signal that something fundamental, something big, has just changed for the better in that business. It gets the attention of the big money, the institutional investors, and it shows that the company's momentum isn't just steady, it's accelerating right now. All right, that brings us to A for annual earnings growth. A big spike in one quarter is awesome, for sure, but O'Neill needed to see proof that it wasn't just a flash in the pan, not just a one-time fluke. And what he found was that the truly great companies back up that recent surge with a really solid track record. So you're looking for at least 3 years of consistent, strong annual growth. Ideally, we're talking 25% or more each year. When you get that solid history combined with that sudden pop in quarterly growth, well, that's an incredibly powerful signal. And the final letter in CAN is N, which stands for new. Think of this as the catalyst, the spark that lights the fire. Great performance rarely just happens. It's almost always driven by something new. These huge, explosive stock moves are almost always tied to something new. A game-changing product, new management shaking things up, or a new all-time high in the stock price. And yeah, this is one of O'Neill's most counterintuitive rules. Most people get scared of stocks hitting new highs, right? But his data showed the exact opposite. Buying a great stock just as it's breaking out to a new high is often the perfect time to buy. It's proof positive that the big institutional money is flooding in and confirming the trend is real. Okay, so that's the CAN part. Now let's move on to the SLIM checklist. This is all about identifying the market winners. If CAN was about the company's internal fundamental strength, SLIM is all about how the market itself is reacting to that strength. Let's dig in. We're going to start with S, and that stands for supply and demand. This really just boils down to the basic economics of the stock itself. How many shares are out there for people to buy, and more importantly, who's trying to buy them? So what O'Neill found in his research is pretty fascinating. Stocks that have a smaller number of shares available to the public, that's what we call a small float, they often make the most explosive moves. It's simple, really. When you have huge demand from big institutions all trying to buy a stock that has a limited supply, well, the price only has one way to go, and that's up, fast. Next up, we've got L for leader or laggard. And this one directly attacks a huge mistake that so many investors make. They love to buy the cheap, beaten-down underdog, hoping for a turnaround. O'Neill's data says, do the exact opposite. You don't want the sympathy buy, you want the champion. His data on this was crystal clear. Buy the strongest stocks in the strongest industries, period. He even came up with a simple way to measure this called a relative strength rating. It just ranks a stock's performance from 1 to 99 against all the other stocks out there. The rule? You only want to focus on the leaders, the ones with a rating of 85 or higher. Why? Because winners just tend to keep on winning. All right, the I stands for institutional sponsorship. Look, a great company is fantastic, but you need the big dogs on your side. We're talking about mutual funds, pension funds. Their buying is what really moves the needle on a stock's price. But here's the key. It's not just about any institution owning the stock. You want to see the top-performing, smartest funds getting in on the action. That's the ultimate seal of approval. And finally, we get to M for market direction. And I gotta tell you, O'Neill considered this the single most important factor in the whole system. The reason is pretty simple, and it's powerful. You could find the most perfect stock in the world, one that checks every single box. But if the overall market is heading south, 3 out of 4 stocks are gonna go down right along with it, no matter how good they are. So, the big question is, how do you know when the coast is clear? Well, O'Neill identified a really specific signal he called a follow-through day. Here's how it works. After the market has been down and then tries to rally for a few days, you're on the lookout for one specific thing. It's a single, powerful day where a major index like the S&P 500 just surges higher on way bigger than average volume. That's your green light. It's the market's way of shouting, the big guys are back in business. But, buying is only half the battle, which brings us to our next section. Winning by selling right. Finding a great stock is awesome, but O'Neill argued that knowing when to sell is maybe even more crucial. And his rules on this, they are absolutely 100% non-negotiable. This right here might be the most important rule in the entire book. Seriously. And it's not a guideline or a suggestion, it's an ironclad law. It's all about one thing, protecting your capital from a devastating loss. And the rule couldn't be simpler. No exceptions, no second-guessing, no crossing your fingers and hoping it'll come back. If a stock drops 8% below what you paid for it, you sell. End of story. And the reason he's so strict about this, it all comes down to some very simple and very unforgiving math. Look, an 8% loss is painful, but it's manageable. You only need about a 9% gain to get back to where you started. But just look at this. If you let that loss snowball into a 50% loss, you need a 100% gain. You have to double your money just to get back to even. This rule isn't about ego or being right, it's about survival. And that brings us to the final, and maybe the most difficult part of the whole system, the ultimate challenge. Because when you strip away all the charts, all the data, and all the rules, success really boils down to just one thing, your discipline. O'Neill made it really clear that understanding the CAN-SLIM checklist is the easy part. Anybody can learn the rules. The real work, the hard part, is having the guts and the discipline to follow it, especially when it feels uncomfortable. It's about actually pulling the trigger when your emotions are screaming at you not to, like buying that stock at a new high when it feels scary, or selling for that 8% loss when every fiber of your being just wants to hold on and hope. So in the end, he argues that success in this isn't really about being the smartest person in the room. It's about emotional fortitude. The system is a map, one that's been derived from over a century of data. The challenge isn't the map, it's the navigator, which leaves us with one last question. The system is a map. Do you have the discipline to follow it?